Hey fam, what's good? What's good? I hope this show is well and keeping safe. Welcome back to another one. Today we will be covering time frame correlation. Okay, so let's get into it. Time frame correlation. It's important to know what is happening on all your time frames before entering any trade. You don't want to be fixated on only one time frame, right? So you're not going to come to the market and be like, I'm only going to look at my H1 time frame. I'm only going to look at my H4 time frame. I'm only going to, execute my trades on these ones. I don't care what is happening on the lower time frame. I don't care what's happening on the higher time frame. No, right? That is not how you're going to find yourself participating inside the market. Look at it as you are painting the picture on both sides, right? Just like a coin, you need to understand that, if you are going to stand on the edge, right, you know what is happening on this side and you know what's happening on that side right there, right? So with you standing on top of this coin right here, you're going to make the decision whether you want to go with heads, whether you want to go with tails, right? Which picture is making sense to you, right? And that's how you're going to find yourself, executing your trades. You need to find yourself making sure that you have an actual picture of what's happening on the higher time frame and you have your picture on what's happening on the lower time frame. Okay, so let's go to the next slide. We are going to start off with fueling, right? What is fueling? Fueling is simply when one time frame is complementing the next time frame, right? So for example, your weekly market structure will fuel your monthly time frame. So I'm simply saying if my weekly time frame would have to be bearish in structure, right, this simply means that my monthly time frame will also have an actual shift back towards the downside, right? They are complementing one another. My daily time frame market structure will fuel my weekly time frame market structure, right? So if my daily time frame is bullish in structure, this simply means that this will push the market towards the upside as well. You know what? When it comes down to our weekly time frame, same thing goes with our 4-hourly time frame, right? Our 4-hourly time frame market structure will fuel our daily market structure. So if we are bullish in structure on our 4-hourly time frame, this simply means that our daily time frame will have an actual shift towards the upside, right? H1 time frame, same thing. If our H1 time frame is bear in structure, right, this simply means that our H4 time frame will have a push towards the downside. Okay, 15-minute time frame market structure will fuel your 1-hourly market structure. So if the 15-minute time frame is bullish in structure, what's going to happen on your H1 time frame? Your H1 time frame will literally have an actual shift to the upside, right? That is fueling right there. Now look at the following example as well. So now I want you to look at this example over here, and this is literally how it applies for each and every single time frame, right? Now 15-minute, 1-hourly time frame. Right now, let's look at the 1-hourly time frame over here. So here you can see that the 1-hourly time frame is clearly bullish in structure, right? How do we know that it is bullish in structure? Simply because we have a nice high to a market giving us a nice higher high over there as well. Now we can basically see on our H1 time frame that we are having some sort of an actual turning point, right? But we want to take price short, but we don't know whether price is going to go to the downside, right? How are you going to find yourself figuring this out? So as you guys know, right, after a market creates a higher high, you expect some sort of initial pullback. Where can that pullback potentially be? That pullback can literally potentially be back into this previous area of resistance, which is now currently serving as an area of support, right? Now with you seeing this nice little bear candle on your actual H1 time frame forming, this is where you're going to go to your 15-minute time frame, right? So this area which you are currently seeing on the 15-minute, this right here, right, is literally just price zoomed in on what's happening right over there, right? So looking at your 15-minute, you can see that we have a nice uptrend over here, but look at what we found ourselves creating. we found ourselves creating a beautiful double top formation over here, doing what? Literally changing market structure to bearish, right? So check this out. You have a nice actual low, you have a higher low, you have a higher low over there, and then boom, the market created what? A lower low, right? So with the market creating a lower low, you already now know that, you know what, structure is bearish. So what are you going to find yourself doing? All you're going to find yourself doing now is literally box out your neckline. Just like that, you're going to wait for price to pull back into your neckline. And this is where you're going to find yourself looking for some lovely shorts towards the downside. Where do you want to find yourself taking price into, right? This is literally where you can find yourself looking at your H1 time frame, right? And this double top formation, which you are seeing on the 15-minute, right, will give you a confluence to where price is heading, right? This simply means that on your 1 hourly time frame, this is what you're going to see. You are going to see price hit all the way down back into your previous area of support, right? And on your 15-minute, all you're going to see is literally price creating a nice double top formation, right? Changing market structure to bear. And can you see that is how your 15-minute complemented your 1 hourly time frame to hit towards the downside, right? So that is how you basically look at time frame correlation. That is how you find yourself doing top-down analysis as well. Okay, so now let's look at another example, right? So this will basically be your monthly time frame. This will basically be your weekly time frame, right? So you are seeing that your monthly time frame is overly extended towards the downside, right? Market structure is bearish. We are creating a lower low over here, and you want to see price have some sort of an actual push towards the upside, at least back into your previous area of support, which is now currently serving as an area of resistance, right? So monthly time frame, you are seeing that you have some sort of an actual push towards the upside. Now your weekly time frame will complement your monthly time frame. So now you are basically seeing on your weekly time frame, but hey, we are creating what? A left shoulder, a hit, a right shoulder right over there. So the only thing you're going to find yourself doing right now is literally get out that nice little neckline, right? All you're going to wait for is for price to push back inside this area, wait for your rejection, and price will literally push towards the upside, right? And with price pushing towards the upside, what do you think what's going to happen on the monthly time frame? Your monthly time frame is going to have a beautiful shift towards the upside, just like that, right? And that is how your time frames is correlating and literally complementing each other. Back to our presentation, time frame correlation, right? So the following would be an example of how you should be looking at your charts before entering a trade. Right now, this is what you're going to see on your daily breakdowns quite a lot. Right now, we have our different types of traders, scalpers, day trader, intraday traders, and our swing traders. Right now, let's start over here with our scalpers, which is literally me, right? And most probably a few of you, if not all of you, right? So our scalpers, our directional time frame will literally be our H4, H2, and our H1 time frame, right? So we want to see whether we are bullish or bearish on our higher time frame, right? And our entry time frames will literally be the following: our 30-minute, our 30-minute, 15-minute, 5-minute, and you know what, sometimes our 1 minute as well. We are in and out of the market, right? We are in and we out. Our day traders over here, their directional time frames will literally be the daily time frames, the 4-hourly time frames, and the 2-hourly time frames, right? So this is where you want to see whether our bulls or our bears is in control, and you're going to make a decision after that, right? Your entry time frame will literally be your H1 time frame, right? And these traders will hold for a few hours. So can you see your day traders are literally entering the actual trade, and they can find themselves doing whatever they want, right? After every hour, they can just come back and check up on the actual trade, on, you know what, how it is performing. Our swing traders on the other side, you know what, their directional time frame will literally be the monthly time frame, the weekly time frame, and the daily time frame, right? So these are your higher time frames. You want to see where price is going in overall, right? And obviously you're going to find yourself holding for quite a while as well, right? Entry time frame is the 4-hourly time frame, right? So 4-hourly time frame, enter your actual trade. Every 4 hours you can come back to come check up on your trade and see how it is basically performing, right? So 4 hours, that's quite long. That's quite long. So these traders, they will hold their trades more than an actual day, right, as we discussed. And then you also have your position traders, right? These are considered as your investors. They hold their trades for months and years, right? NB, you need to respect your style of trading, right? So if you are a scalper, this is what you're going to find yourself looking out for. If you are a day trader, intraday trader, this is what you're going to find yourself looking out for. Swing traders will look out for this right there, right? Don't disrespect your style of trading. Don't be an actual scalper, but then you are looking at your monthly, weekly, and your daily time frame. No, you are tapping in a different territory, right? Don't be an actual intraday trader, but then you know what, you are looking at your 4-hourly, 2-hourly, and 1-hourly time frame, right? Rather focus on what's happening on your daily, 4-hourly, and 2-hourly time frame, right? So please do respect your style of trading. I hope you guys have a clear understanding of what time frame correlation is and how each time frame is literally fueling one another. Okay, see you in the next one. I'm out.